Uh, Welcome everyone to the Q4 and FY22 investor call of 3i Infotech Limited. On the management, we have Mr. Thompson Gyannan, Managing Director and Global CEO, Mr. Harish Shinoy, Chief Performance Officer, Mr. Sanjay Rawa, Chief Financial Officer, and Ms. Varika Rastogi, Company Secretary and Compliance Officer. We will begin this call with the opening remarks from the management, following which we will have a forum to answer your questions. Before we invite the management, we would like to share a few guidelines for smooth progression of the event. All the participants will be placed on mute mode. We will take questions post the management address. For any queries, we request you to use the Q&A window to type your questions, or you may use the raise of hand to ask your questions. We will accordingly unmute you, and you can unmute yourself and go ahead and ask a question for the smooth progression of the interaction. I would like to request Mr. Thompson Gyannan to address the participants now. Thank you, and over to you, sir.
Thanks, Snyder. Good afternoon, good evening, good morning, everybody. It's been a wonderful year. Thanks a lot for the great support all you shareholders have given us in this year. It was a very remarkable year for all of us because we have come out of the carve-out last year, and a new 3i is born, and we have been building this new 3i. It's been a fantastic year for all of us. It was just 4 quarters ago we had our first presentation, and I think time just flies, and it's been very exciting. And we are also very, very happy to kind of share the progress we have made and also the plans which we have for this financial year. So quickly, just to refresh ourselves, when we started the year, we wanted to kind of set a goal for ourselves, and we said that we'll be a $1 billion company, and we said we'll be at AIM 30. So as we move to the next slide, Schneider will be helpful. Yeah. So just to refresh everybody's memory, we set a goal for ourselves that we'll be a $1 billion company, and we called it AIM 30. So this is very important for us as an organization to galvanize the entire organization, to seamlessly see how the entire organization to move towards single-mindedly towards this goal of being a $1 billion company. It was very important for 3i because 3i used to be a $1 billion company way back in 2008. So it's important for us, this milestone we achieve as a team in this new rebooted organization of 3i Infotech. So we also redefined our vision, mission, and goals for ourselves. Quickly, to be on the vision for ourselves, just to remind all of us, we said to be a trusted global one-stop digital transformation partner who will deliver business excellence and exceptional outcomes to our customers in this new digital decade. It's very important for us. This is a kind of a North Pole for all of us. We also set ourselves with a 10-year plan, very clearly saying that what is that we're going to achieve year on year. So the year gone by, we set ourselves a goal saying we want to hit 630 crores, and we will share the highlights of our results. And we also had milestones in terms of what is that we will be able to achieve in various points of time in our journey to become a 7,500 crore organization. So as we move on to the next slide, just to also refresh ourselves, we said we'll break this 10-year journey into shorter milestones. So the next 5 years, the year one, we very clearly said this is a year of change and differentiate, because we are coming out of a carve-out, a profitable product management, product division has gone away. We only inherited the services organization. We had to build an all-new organization again. The good thing about that is the product organization made 3i debt-free. That's the positive. But then we had to restart, rebuild ourselves. So we proudly call ourselves, a kind of a $90 million startup organization. So that's the mantra in which we have been building. So change and differentiate was the theme for the first year. We wanted to kind of lay a strong foundation for future growth. Started to drive the change management, because it's very important as a company which is rebooting. We need to rediscover ourselves, recalibrate ourselves, right skill our people. So the important point is to align, believe, and drive business with conviction. I think that's an important point. And the important thing which an organization which we realized is for where we 3i is at this point of time, where we are on a catch-up mode with all our peers, we need to differentiate to survive and thrive. It's very, very important for us. We cannot do what our peers do because we have a catch-up and we have to differentiate and to survive and thrive. That's a key message, the year one change and differentiate. I will touch upon some of these points as we go by. The second year now, as we embark on this new year, very clearly we want to disrupt and challenge. A very clear year of disruption and challenge, because that's the only way 3i will thrive. So we need to catch up and accelerate. We want to hunt together as one pack, as one organization, across functions, across teams. We want to hunt together as one pack. That's very, very important for us. Disrupt competition with commercial models, because we have to be a disruptor with coming up with more intelligent, innovative commercial models. We want to be an organization who's not risk averse. We are ready to explore, we are ready to experiment, we are ready to fail fast as a challenger. So that is going to be the core DNA of the company going forward. So just to quickly refresh our memories of our offerings. Fundamentally, if you look at it, we kind of sharpened our offerings. If you look at the next slide, we called it AAA, which is our core offering, which is application, automation, and analytics as a service, which is our core. We brought
Sorry
in cloud
to
first.
Thompson sir, I think some are unable to hear you. Could you be a bit loud or a little closer to the speaker?
Okay. Am I audible now?
Yeah, that sounds much better.
Okay.
Yes.
Okay.
Yes. Thank you, sir. Yeah,
Yeah.
please continue.
So on the next slide, on the offerings, if you look at it, just to refresh our memories, we kind of made our offerings more streamlined, very focused. So AAA is our arrowhead offering, which is application automation and analytics as a service. Cloud First is a kind of an arrowhead which we built now with our new range of services. We'll talk about it. We have a digital KeyPass and BPass, digital BPS, and Future Tech Technologies is our build organization where we are building next generation cognitive computing, edge computing, 5G lab as a service, so on and so forth. We'll talk about that. Digital infrastructure management business, which is a mainstream business. And we're also now selling global command center as a service. So broadly, these are our key offerings by which we are going to the market. And so what I will do is, I'll quickly give a business summary of the year gone by. Next slide. A busy slide, but I'll kind of call out the key points for everybody's benefit. See, quarter on quarter, we have been having a challenging year because we are managing a lot of our legacy issues, one-time cost. We've been doing a lot of proactive cleaning up of our P&L. We will talk more about that just to refresh all your memories. But Q4 was a great quarter for all of us because Q4, as an organization, we got our operating rhythm, our operating profits. So that's a very, very important point for us as an organization because as a new services company, we have been able to now generate profits. That's very, very important for us. So if you look at Q4, we kind of exited with 175.6 crores, which is almost 6% growth quarter on quarter, and an annual 677 crores, which is 11.2% growth on last year's exit services revenue. I think this has been the first major growth for 3i in quite some time. And that too after a carved out entity. I think that's a remarkable performance by the organization with so much of variables. And now this momentum will help us to go forward. On even the EBITDA level, if you look at it on Q4, we have been at 3.5 gross profit, though at consolidated at PAT level, we've been at minus 3.9 crores. But the good point is at an operating level, we have now hit profitability. That's the message I want to leave to the shareholders. That is a profitable, we have turned around, we got our numbers right, we have eliminated all the exceptional costs, and we are now into the green zone. So that's the positive which I want to call out. If you look at the net cash, we exited with 73.4 crores. We spoke about the revenue growth, which has been pretty good for all of us. And if you look at the year-on-year gross margin growth as well, we've grown almost like around 11.2%, which is also an addition of almost 28.9 crores on the gross margin level. So as we optimize our cost, as we drive improvements, my other colleagues will also talk about all that, we will see that, the upside in terms of the EBITDA coming in. In terms of the business and strategy, just to refresh our memories, the year gone by, we have signed a strategic alliance with MDEC Malaysia. In fact, we are launching our first NewRay 3i Plus services, which is the Oracle-powered sovereign cloud services in July. Unfortunately, due to the digital supply chain delays, we are supposed to go live in April. We will finally go live in July. This is a huge strategic way forward for the company because we will offer NewRay 3i Plus powered services for the SMB segment in Malaysia. This is a huge, one of the strategies which we executed. The second thing is from a NewRay product launch, from a 3i Plus, we have gone live on NewRay 3i Edge and Desk. And in fact, the good news is that some of these products have now started getting their own customers. So they are becoming independent line of businesses for this year. So we are considering, revenue plans for these products which are built and launched last year. So that's a very, very good news for the organization. We have invested in XCM. You have seen the press releases. It is also part of our build strategy where we want to have strategic partnerships with startups, to bring them part of our kind of ecosystem, and we want to kind of see how we can co-create IP. So this is a first step forward. XCM is a next generation technology company with 5G frameworks in terms of, which are deployable at 4G. And this is going to give a huge, momentum for our edge computing business. So in terms of SASE, in terms of edge security, in terms of edge analytics, edge application, be it in 5G, this is a huge step forward for the company. And we are going to co-create IPs, which we want to take into market along with XCM. Resident Entrepreneur Programs is live. We spoke about it in Q3 as well. Cognitive Computing Services is now calling revenues this year. And we have Edutech vertical, the second Resident Entrepreneur Program, where we are now going to offer a cloud-based educational ERP as a service for us, for our clients. The other important aspect, we're also making progress in SD-WAN and SASE built on XCM technology as well. Finally, our telecom, media and entertainment COE is now live. We have got the teams, we are going live. And this year, it's a huge focus area for us to kind of execute our promise around 5G powered services. We are now setting up our 5G lab as a service. As we are speaking, our first build or next gen services lab is now being set up in IIT Madras Research Park, and you will see the launch very shortly. An Oracle COE is now being built, and we are launching this. This is an exclusive Oracle COE end-to-end, not just from the cloud, the entire end-to-end in terms of application development, testing, focused on Oracle. We are launching this 100-member COE and in a Tier 3 city, and we are opening it in mid of third week of June. We will keep you updated about it. We are very excited about it because all these are going to enable the company to generate more profitable revenue. And in terms of delivery excellence, this is one thing which we want to kind of stay focused this year. It's very important for us to keep optimizing our run business, investing in our grow business so that we can change the revenue mix, and invest in our build business so that we can create IP and valuation for the company. So delivery excellence is going to be a very, very important aspect of it. And Harish here drives this along with, Sanjay, because it's very important that we drive these margin enhancements programs so that we're able to kind of, and this is the first time I think 3i is giving an outlook to our shareholders right now. So very confident that we're going to hit these numbers on a kind of what I call the blood commit. And quarter on quarter, we will come back and report back on that. On client side, if you look at it, we have added a lot of new MSAs. This year, we need to kind of expand these MSAs. It's a very important point. We have new MSAs of almost 48 new customers. Every small customer, big or small, is important. It's important for us to now start farming these customers, expanding these accounts. So the good news is that if you look at last year, we almost added 106 crores from our existing clients in terms of new revenues, which we added last year, which was very helpful for us to bridge some of the erosions which happened and still also grow almost close to 11%. So building on our existing customers, farm them is very important, and how we want to maximize our revenues on new logos is also a very important strategy. And this year again, we are taking a target of almost 100 crores on our book across our grow and build. I'll talk more about it in the way forward slides. We spoke about some of the large deals we have taken in US, which is now contributing revenues. Our run rates are increasing. Those profitable revenues will change the revenue mix and the margin mix for the years to come. So I'll move on to the next slides because I want to have more time for questions. So if we quickly go to the Q4 highlights, just to touch upon it, but I'll allow Sanjay to talk about it when he comes to his slides. But broadly, I want to leave some key messages here. If you look at it, last year we exited 608, if you look at it, and we are hit around 676 crores, which is a very positive momentum in terms of revenue momentum we got. Proportionately, our direct costs have been optimized. If you look at our GM has gone up, from 66 to 95.4. Now we need to work on conversion from GM to EBITDA. So that's a real focus for this year. So we got our basic foundations right in terms of revenue momentum, in terms of GM enhancements. We have done that. We need to now optimize our costs. And this year, without all the one-time costs which we had last year, just to refresh our memories, we proactively took a hit of almost 16.3 crores in Q3 for slow-moving debts. Because as a company, we said that we're going to clean up all these slow-moving debts to get our foundations right. So we took that hit of almost 16.3 crores. Our selling cost is now optimized because we were now kind of I would say that we want to deploy our selling costs more towards the grow and the build rather than the run. So we're kind of calibrating our cost, redeploy our costs in such a way that we get the maximum time for a buck. Our GA cost is getting optimized. We will optimize it further this year because a lot of optimization, and I'll allow Harish and Sanjay to talk more about it because we want to optimize that further because that's the only way we'll be able to hit the outlook which we are promising to all of you. So as you go to the next slide, if you look at, it'll give you a kind of a lines of businesses' performances across the various lines. If you look at it across application automation and analytics, the infrastructure management business has been pretty good for us. I think there's huge momentum in that space. Even right now, as we speak, we call it the digital infrastructure management business. We have been disrupting our own traditional data center management, your FMS business. We are disrupting it with our own technology, Maggie-powered enablement into that. So we got an upside on our GMs there. If you look at it, it's gone up to almost 23.2%, which is the positive side, which I want to call out. And if you look at the bottom one as well, the Cloud First, which is our new baby last year, which has opened its account. And it's the good news, we got our large deals, which is going to build further. If you look at it, the GM is almost 48%. This is the type of business we want to change this year. This is very important that we get into this revenue mix change, which is extremely important for the company. We're going to change the mix and enhance the margins and create value for all of you. So as you move on to the next slide, if you look at it, I'll quickly give a business region LOB mix as well for benefit of everybody. We have kind of renamed our regions. I spoke about it in Q3 as well. IBR is India Business Region. GBR is Global Business Region, which is Americas and EMEA. EBR is the Emerging Business Region, which is South Asia, Japan, Australia, and New Zealand. Japan, Australia are new geographies. We want to kind of expand this year. It currently is just Southeast Asia if you look at it fundamentally. Broadly, the areas for improvement for us this year, very clearly, we want to look at our IBR business in terms of profitability. But there's huge tailwind in terms of order books and in terms of business growth, which is there from IBR we're expecting this year. But in parallel, we'll have to work on optimizing cost and increasing our margins, which is our focus area. GBR, we've been kind of holding growth, but this year we need to kind of focus on the revenue mix change. Big geographies, we want to focus on a grow and build business. Not really focus on the volume, but really focus on the value change. So IBR will drive volume for us. GBR will drive value for us. So that's a very, very clear mix change. We want to talk about it in terms of, the new lines of business. We want to have the GBR anchor it. And that's the kind of business plan we have put together. EBR is something where we want to reboot ourselves, come back, get back some of our lost ground in some of these territories, and relaunch ourselves in some of the new geographies as well. Broadly to summarize, if we look at it, EBITDA margin will be a key focus across all regions. It's a relative statement. They all have to improve. And, we are looking at GBR going up to almost like 15% and India going up to almost like 8%. And that's what we have to kind of target. And EBR going up to almost 10% at the business EBITDA levels. So this is the key focus for the business regions. As we move to the next slide, which gives you a kind of, I'm not going to talk through it, but broadly gives you a kind of split of the business, because these are most of the questions which are normally asked. We kind of wanted to share the mix of, so this year, very, very clearly, our focus area will be on telecommunication. We are now building a telecom COE, where telecom, which is sell to telcos and sell through telcos. So as I'm talking to you, we are now working with telcos to partner to take our Neure Edge to their customers. So this is a force multiplier. So next year when we talk about it, we will see telecom revenue mix changing dramatically. The second focus area will be in manufacturing. Very clearly, we want to focus on the mid-market and SMB. Again, Neure powered SMB segments in the manufacturing, in the FMCG is something which we want to focus. So these two will be our focus areas, and we want to kind of invest in building this as we defend and grow our BFSI, high-tech and information technology as we continue to do that, but we want to grow these new industries. So I go to the next slide, which also gives you a kind of a split across top clients. So this is it's an opportunity for the company. I've always said that because it is important for us to build on these $1 million customers. We have 17 customers who give us greater than $1 million plus. So this is a very clear revenue, and where we are targeting to get our first, some of them we got $3 million or $4 million, but now we want to get this $5 million club. So how do we get to this $5 million a target for some of this $1 million customers? And we also need to kind of increase this 500K to 1 million also to $1 million. So that's a very clear account-based strategy which we are working on this year. So that's a company is super focused on, it's an account-based strategy, whether it's an account P&L, so right from our geography P&L, we want to look at an account P&L and want to see how an account-based strategy in terms of marketing, in terms of sales, in terms of practice, in terms of now offerings, we want to stay focused on this. So this is going to be a very, very important business KPI, which we want to focus and report to all of you on a quarter-on-quarter basis of how this mix changes, how our order book changes, how our revenue recognition changes, how our profitability changes across customers. So maybe I'll take a break here, and then maybe I'll request Sanjay to give us an update on, I want to move on new slide, next slides, slide up. Can give us the update on the P&L and the balance sheet. Sanjay, yes.
Thanks, Thompson. Good evening, everyone, and thanks for joining the call today evening. Just wanted to give a kind of a snapshot of our key financials, that is the profit and loss statement and balance sheet. Most of you guys would have kind of gone through the numbers. So I'll give you some key numbers that we have, which I wanted to kind of highlight. The numbers for the top line, we grew by, for the year by, 11.2%, which is about 10 crore revenue in terms of top line. Primarily, the revenue has, come up due to our US region growing and the India region growing. These are the two major regions which have grown. On the employee kind of cost side, we are kind of on a quarterly basis have done a lot of margin improvements. I think that has been one of the significant reasons for our EBITDA to be positive. Thereafter, I would say we are working now on the bottom line to see that we come from the break even to show that we get to a positive PAT in the coming quarters. That's been our endeavor, and that's what we are working towards. Quickly going through the balance sheet part, I want to give some basic highlights of the balance sheet. Our capex for the entire year has been, if I remove the right to use assets have been about 29 crores on the various leased assets that we have taken for our activities, which is primarily laptops that we take. So we have our own laptops which we have taken for about 7 crores in office renovation. So it's been about along with the capital work in progress that we have also actually accounted in Q4 towards our build technologies, towards the build projects that we have. We have a total capitalization of about 18 crores, which excludes the leased assets, right to use assets. That's one of the key factors in the asset part of it, on the fixed asset part of it. Coming to the that's on the more on the asset part, and on the current assets part, our trade receivables are more or less in line with the last year. In fact, on an increased revenue, we were able to kind of collect a lot of sticky debts, I would say, over the last 1 year. That has resulted in our DSO going down by 2 days. Our billed DSO has come down from 53 days to 51 days. And unbilled, put together, unbilled has been more or less the same number. We are working towards, so unbilled is at about 40 days right now. So overall, put together, we are at 91 days of our billed and unbilled as a DSO for the company, which we are working towards to further streamline and see that how we can kind of reduce that over the coming quarters. Our cash balance has been at 128 crores. That also includes certain margin money deposits that we place with our various, I would say the customers for performance guarantees. On a pure play, I would say our cash balance has increased over the last, I would say not over the last quarter, we have made a significant improvement. But our net cash after the borrowings is at 73 crores. That's a kind of a positive side. So we are not at a negative net cash position. So, I mean, these were the few of the major highlights, and other highlights have already been kind of talked about. We've been able to clear all our debts. We are a kind of as a company, we are a debt-free company. We have some short-term working capital borrowing for our expansion purposes, which we are time and again will be kind of taking. But on our long-term debts, we are cleared. We don't have any debt for the company. So that's a highlighting point that I want to say. So that's all I have from the finance. Any questions further we have? Happy to take any questions further. Yeah.
We will take it to the end. Yeah. Thanks, Sanjay. Maybe we will quickly go through that and we'll keep more time for the questions.
Yeah.
So quickly, what I thought, this is the year gone by, but let's talk about the year ahead. So I think that's the most interesting part, which we wanted to share with you. We're all excited to share with you. So quick glimpse on the business strategy for everybody's benefit. If you go to the next slide, just to refresh our memories. Now I think we use these 3 terminologies: run, grow, and build, which has become our fundamental methodology by which we want to run these businesses, and each are independent P&Ls in various stages of maturity. So the run is predominantly our current enterprise businesses. Grow is the new lines of businesses which we are building. Run. So the run plus grow are like the total 2 P&Ls which we are so focused, And if you look at the statement which we make in run plus grow has to be profitable, as simple as that. Actually, it's very, very simple. Build is something which we're building for the future. This is value creation, IP creation, and this build, once we build these platforms, productized services, IP creation, beyond that, it is also becomes commercial grade and gets into the growth. So that's a kind of a cycle which we want to kind of, use that. So build for grow and come back to grow as a P&L. And that's the way we want to do that. Some of the build projects will accelerate very, very quickly so that we can commercialize them very, very fast and our ROIs can be faster. So quickly on some run headlines, I'm not going to kind of, go through this. I allow you all to go through these things. One of the key things we want to do is also we also have legacy subsidiaries and organization structure which is being handed over to this new 3i. We are quickly working on, shutting down subsidiaries which are not part of the global way forward, advised by one of the big fours. And we're going to restructure the entire global organization structure and shutting down all the old subsidiaries and realign the new organization structure with the way forward. So that's one thing which we're doing in our war footing. It's very, very important for us because we need to align the strategy with the organization design. The second thing is also very clearly we want to be ruthless about eliminating any non-profitable engagements. We've done that in a systematic way. We want to do it more. That's why I said in terms of account P&L focus, it's going to be account-based, it's going to be project-based. We want to be very, very clear about that actually. And we want to kind of reduce / right cost the support of existing businesses. We need to dimension this cost because any carve out, when you have a highly profitable product business going away and the residual organization services business, which is a product-led organization, and we need to kind of right cost or right size the entire support organization, which we are doing it, and we have made some progress, but we need to get that right because that has to be kind of lean and trim to support it because we need to kind of fund the future organization. So we need to kind of right size the support organizations here. So very, very clear about it. And again, it's very important to right skill and reskill the organization because it's very important for us to fortify the run accounts as we are growing new lines of business. We need to ring fence our run businesses because it pays our bills. So we also want to proactively cannibalize some revenues in deploying the new grow and build also. We have kind of taken it in our budgets. It's a very bold call. Companies don't do that, but we've taken our budgets saying that we're going to proactively cannibalize some of our revenues to demonstrate our grow and build. Because this is again part of the entire DNA of experiment, explore, and fail fast. And demonstrate to the world what we want to kind of practice, what we preach, we want to practice. It's very, very clear. It's a message which we want to do. The grow business, I think we have talked a lot about it. So this year is a year of New Ray. New Ray is the new brand which 3i is pushing across, whether it's going to be, and this year we will see very, very, very clear change in terms of New Ray lines of services, the new revenues being added across 3i Plus, 3i, Edge, Desk, and all the new lines of services. We will talk about it. And secondly, we want to kind of come up with more, commercial models which will challenge status quo. So we want to kind of do that. We spoke about the sell-through to telecom. So watch out for us in terms of, we report in the same lines, what is our telco business is going to give, whether sell to telcos or sell through telcos, as a new industry vertical. The SMB segment in market manufacturing, we want to talk about it. The New Ray line of services is something which you want to, focus and drive the revenue mix change. To build business, just to say, cognitive computing is going to be the spearhead there, which is going to kind of lead. And we have all the investments we have made last year will now start giving us revenues, be it in data science and analytics. It's going to be in self-learning technology. So we're going to do that. We invested in Oracle COE, you spoke about it. We're going to do that. And some of the investments we make this year will be on 5G lab as a service. Is something which you want to focus. I'll update you how we are going to take it forward. And there's a good market for it. And we want to be leaders in that and be leaders in edge computing. And Industry 4.0 in terms of manufacturing ready, convergence of IoT, edge computing, edge analytics is the way forward. Private networks and SD-WAN is a huge focus area, which we want to talk about it. We got some good funnel in this, and we'll be happy to report some of the victories of deals once we close them in the coming quarters. We'll move ahead. So quickly, just to refresh everybody's, because this is the design structure and the go-to-market for the company. We are divided as regions, which is the P&L of the company, is broken down into GBR, IBR, and EBR. The next is the industry verticals. Within the industry verticals, we have the accounts. So that's the entire P&L structure of the organization, the way we want to look at it. Horizontally, we have the run business, which is the enterprise services, which are traditional lines of businesses. The digital business, which is the grow business, all the new lines of services we spoke about. Future tech is the name you're given for our next generation technology, cognitive, 5G, that's how it is. And we are also building a consulting business today because last year, due to our priorities, we could do it. But this year, the focus area will be to strengthen our consulting business because we want to be that end-to-end business outcome service provider. But we need to strengthen our consulting, business consulting capability to bring that convergence between domain, industry, and technology. So that's very, very important. The balance of the horizontals who will support this organization structure and design. So go to the next slide. Again, it's just a refresher for all of you because this is our North Pole. We don't change it. This is the way we want to look at it. How we want to change the mix of revenue from volume to value, from transaction pricing to outcome-based pricing, and how we want to increase the profitability from 15 to 25% to higher margins is what we want to focus. So this is a very, very important slide which will keep reminding ourselves on what are the lines of services, what we're doing today, and how do you want to change this mix. And as the quarters go by, we will be happy to share how the revenue mix is changing in each of these quadrants. Because that's the focus for this year. This is not only a year of providing sustainable profits in operating level, but also trying to see how we are going to change the revenue mix for the company. I'll move on to the next slide. So here I would want to request Harish to come and talk about it because it's very, very important for us of how to convert this entire business strategy into a business excellence framework, a human capital and a people strategy, because very, very important for us. And I'll request Harish to kind of talk about this.
Thank you, Thompson. Good afternoon, good evening, everybody. So I think a lot of information on this slides. A few numbers on the top side is the vision that we want to achieve. We have given the timelines also and the numbers that we would want to achieve. And the entire purpose of this slide is how do we achieve the goals that we have set for us as an organization. All the segregation of business, focus areas, all that Thompson has mentioned all this while in the call. I think we need to have strategy to achieve those. So to achieve some strategies, we first need to assess where we stand as an organization. And that's what we have done in this first year of new 3i Infotech, I would say. So we identified what the baseline, where do we stand as an organization? We clearly defined what are the key objectives after we define the baselines, whether it is market development, whether it's process improvement internally, whether it's people development, next-gen technologies, or the cultural improvement as such. So if you look at the initial slides, we started with defining key values for our employees. So that's where we started from as an organization. When we are talking about all these things, we've also mentioned about 835 crores and 30 crores as the focus for FY23. So please don't get misled by this number. This is the focus for us internally to build capabilities. Okay, we can't be building capabilities to what we want to achieve. We want to build capabilities beyond that because at the end of the year, we would want to have an 100 crore order book. So on 1st of April next year, when we are sitting on a 100 crore order book, we should not be looking here and there to see how to deliver that because we've not been scaled to that level. So to scale to that level, we are looking at building capabilities beyond what we will be achieving. So that's where we have split this into like 5 key areas where the organization strategy and the people strategy gets aligned. Key initiatives that we internally taking is we are very clearly moving away from the bell curve people evaluation to a goal congruence evaluation for the employees. When we're talking about this, so it's like the bell curve used to be relative performance of an employee to his peers within the organization. Here, we are very clearly defining what the organization should achieve and what the employee should achieve. It's not relative to what his peers are, it's relative to what his targets were to be achieved for the year and how he's fared it. So it helps us benchmark, achieve what we decide rather than looking around peer competition and infighting among themselves. So it's a cultural change that we are taking up as an organization and we are moving ahead. So having said that, market development, we very clearly know that we have to have increased focus on customers across all verticals that we intend to get into, the industries that we intend to get into. So the selling has been more of about what our competencies are, but now we were moving to an storytelling, consultative sales pitch about how we can, as an organization, help your areas of improvement. I think on there are quite a lot of areas we have picked up on market development. Quite a few of them you would have seen how we have fared in this last year gone by. I think we've done substantial on the brand visibility, where we stood as an organization at the beginning of the year and where we are today. And Thomson definitely has been like interacting with you all, I think more than once every quarter, in various forums, I would say, and that's only going to increase here on because he's also starting to get on to international forums and share our organization's pitch there. So there are various initiatives on the market development that we are taking up, and internally, like I think we have defined the key performance indicators for each of the key objectives that we want to achieve. I'll not go through each one of them, but I think very specific approach in terms of the process automation that we have done, the people development that we are doing. And we have had a lot of challenges in people development, I would say. Instead of people attraction was a challenge for us at the beginning of the year. I think we have sort of tided over that challenge. We have got a strong team at the senior management of an organization, and I think we are building the next level organization now, which will help us achieve the big numbers that we have quoted at the top of the slides here. So that's about what we are talking about people development. Obviously, like the entire industry is hit by the attrition rate that's like going on. We are trying to have multiple different modes of engagement where there is flexibility to the people, how they want to engage with us, whether it's full-time, part-time, different models we have internally, which is helping us tide through this tough times, though we had very poor brand value as an employee-friendly organization at the beginning of the year. I think we moved on from on the employee development index also. Next gen, I think Thomson has mentioned enough about it in the earlier slides. I think I'll leave it to you all to go through it. And I think cultural improvement also. When I think the year FY22-23, we are targeting 100% employee satisfaction internally and customer satisfaction externally with this entire cultural improvement program that we're done. Towards the mid of last year, we've employed market leaders who have worked very closely with our senior and mid-management teams, identifying areas, cultural issues within the organizations. And we've walked quite a bit of the distance there and achieved there. So by and large, this is how we are as an organization aligning people to the business strategies that we have already defined for us in the years to come, I would say. So over to you, Thomson.
Thanks, Harish. Just to summarize on that, I think it's very important for us to have this goal congruence and goal cascading, what Harish spoke about, because translation of this business strategy to the last ranks is very important. That's a focus for us, and in fact, we're changing the entire methodology of marrying the KPIs, business KPIs, and the rewards philosophy for our employees. So there's absolute congruence in terms of what is in it for them and what is for the company and what is in it for all of you as shareholders, actually. So it's very important, and this year is a very critical year where we want to accelerate on this. Thanks, Harish. So quickly on, finally, for the outlook, I think it's a very important point. We want to for the first time, we want to set a formal goal, which all of you can hold us accountable as a management team. As of now, as an exit, as you saw our exit numbers, we are saying our outlook is almost at 760 crores is what we are saying, with an EBITDA of 15 crores. Before all of you jump up saying, I have some of my well-wisher shareholders saying, why only 15 crores? I'll kind of proactively answer some of these questions before you guys ask me. So this 760 crores is a visibility of order book and backlog, what we have today, confirmed, and the plan which we have. Secondly, we are also having investments in our sales organization, right? If you look at it, we're investing in quite a sizable amount in the sales organization, who are now building transformative, consultative sales organization who can help us change the revenue mix, change from volume to value. That's a very, very important point for us as an organization. So that is where we are now targeting 100 crores order book. It's very important for us to get this 100 crores order book. Obviously, the next question is what percentage of that we want to kind of convert this year. So that's the upside we are hoping for. And we can maybe as the quarters go by, we can come and tell you the good news of how we are progressing around it. So this 100 crores order book is kind of a given for us. We are very focused to ensure that we do that. The key part is we want to have a considerable change in the value business in this 100 crores order book. So you look at below, all the new the logos which are there is all the hard work of the build teams which happened last year. They've been extremely busy in building this new line of businesses. This has been a parallel act. How we are safeguarding the run business, we are building the grow business. In parallel, we are building the new platforms and product. It was a remarkable year for all of us. It's a remarkable, challenging year, but we thoroughly enjoyed it as a team, if you ask me. And, we're so super excited about that because these are like new babies, which, we want to see how they can now to crawl, walk, and run. I think that's very, very important. And finally, if you look at the revenue mix also, because this is some of the targets we want to take for ourselves. Getting down into the how part of it. What is the revenue mix change we are going to do? Whether it's Oracle COE or Cloud First or Digital BPaaS, KPaaS, AAA, Cognitive. These are targets we have taken. So even if you look at from 100 crores order book or even within the 760 crores, we want to see, can we get this revenue contribution from these lines of business? Because this is very important. It's not just getting the top line, but can we make a change of revenue mix in this line? Because this is going to be hugely, adding to our bottom line. And also some of the other, SaaS businesses where we want to sell through our telcos. If you look at it, this is huge business. If you look at the Nure Edge, if some of our POCs go well with the telcos, it's a huge force multiplier because we are going to sell it to the telcos customer. So this is huge. And these are some targets we're taking for ourselves, which is sell through telcos. So broadly, this is how the outlook is. Maybe I'll pause here because I think we are kind of going beyond our time. We need more time for the questions. So Snyder, I'll pause here, I guess. Hopefully, maybe I answered all the questions proactively. I'm more than happy to answer any questions, Snyder. Thank you.
Thank you, sir. We will now move to the Q&A session. Anyone who has a question can please feel free to raise your hand. We will unmute you. You can go ahead and unmute yourself and ask your question. And if you have a problem with asking a question on the microphone, you can feel free to use the chat box to ask a question. So we'll just check. Please raise your hand and we will unmute you and you can go ahead and ask your question. So the first question is from the likes of Asif Iqbal. We request you to, we will unmute you, Asif. Please introduce yourself and ask your question. Yes, Asif.
Good evening, Mr. Thompson.
Hi, Asif.
Good evening, Mr. Thompson.
Good evening.
Very congratulations for the better than expected result. We had earlier talked about the result of this quarter in the last meeting also. Many
That's right.
congratulations
Thank
for
you.
coming to the very near profitable target.
No, absolutely.
Thank you. Before I start, I have a couple of questions. Before I start, I just want to highlight one thing. The EBITDA that you are giving for FY 2023, it's just 2% of the total revenue. That is 760 crore. And with that EBITDA, it is we see on a projected basis, we see it's unable to come to the profitable bottom line. Either something is wrong with the EBITDA. So I want to need clarification on the EBITDA for FY 2023 and what would be the EBITDA margin going forward. By when we would see the normalized EBITDA of industry level 15% or 20% EBITDA level. That is the industry average we have. This is one question. Second, I would like to, as we have discussed earlier also, guidance for the next quarter. What would be the revenue and profitability, if not on the growth part, how the growth would be for the next quarter? And what is the attrition rate right now because we have seen big companies having attrition rate of 20-27%. So what is the attrition rate in 3i right now? And how we would see going forward SaaS business would go forward, and what is the traction we are seeing in the market?
Okay, got it. I think you have got 4 questions here. One is on the outlook. I'll try and answer one by one. The first one on the outlook is, just to set a context. I think this is the first time 3i is giving an outlook. So one is we are first coming out of the woods. And this is a projection from a point of time from right now, where we are today. And it will only improve us. The way we look at it as a management team is this is where we are today. And if you see my last slide, I spoke about 100 crore order book we are talking about. And the conversion of the order book, there will be definitely conversion of the order book of revenues this year, right? It's not just you just book orders and you don't convert revenues. And we are hoping there will be the upside to the EBITDA, to your point. So, I would probably leave it at that because that is where the very important point is that what is the outlook today and how it converts into our final numbers is where we are looking at it. And we will keep giving you a progress report on this quarter on quarter because this is the first step forward, Ashish, in terms of at least what we want to communicate is that the past is behind us. The variability is behind us because if you see last 3 quarters, every quarter we had some exceptional item coming to us. We were cleaning up, we were doing all that. So we want to kind of, ensure that there is predictability to our shareholders. So that's the first step I would do that. The second question is maybe the quarter question. Maybe I will not be able to do it right now. Maybe we'll take it there. The third question which you asked about is you asked about the employee attrition, which is what you spoke, Ashish. So if you look at the attrition rate, it's an industry phenomenon. I don't think, obviously we are also having a challenges. Definitely our attrition is higher than, or almost equal and not too much. It's more or less maybe 1 or 2% higher than the industry. That's where we are. So what we are doing is we are mitigating our risks. As I said, we are now, as I'm speaking to you, we are setting up these COEs in Tier 3 cities. I don't want to talk about the city because there will be a formal press release of this opening. The opening is for June 24th. So that's our first COE in a Tier 3 city focused on Oracle COE. So that is something, is a mitigation plan. We are looking at it because there are other peer companies who have done it, and there are literally zero attrition in some of those territories if you look at it. So that is what we want to kind of do that. The other question you asked is when will we get to the level of other peer organizations in the IT industries? So I think just to remind all of you, because this question has been there quite often in every quarter. Because see, 3i was typically a product-led company. It was not typically a services company which you can benchmark with other companies. It was a product-led company which also had services. Now, when you get carved out of that, you are now redefining yourself. So what we have today, if you look at it, if you look at our revenue mix itself, our offshore business is hardly 25%, which is, if I say my export business, which is a straight opposite for any other peer company you go. Because obviously it's a no-brainer. When somebody is doing 75% offshore delivery to US and any of the developed economies, doing that, margins are no trouble at all. So for us we have to systematically change that mix. That is one. That's what we are attempting to do. The second is we also have to develop new products so that we'll have higher margin business. So this is a journey. If you ask me, can we overnight do that? It's impossible. It's impossible to do that because it's a journey where we have to change the revenue mix of what we inherited to what we are now building, and then maybe we'll be able to change the revenue mix. So that's what, if you look at it, if you look at a slightly medium-term forecast, which we gave in 3 years, where we'll be able to hit at least to that levels. By that time, all these new lines of businesses, what we call as value business or grow and build, will start generating those higher margins. So if you see in our chart also, if you look at our cloud business, it's generating 48% gross margin. None of our current businesses do that, but it is very small today. But this year that will become bigger. Some of the new lines will become bigger. So those contributions will change it. So over a period of time, these traditional lines will come down and the new grow and build lines will start going up. And then that's where we'll be able to catch up with the market rates, Ashish. So that is my question. And you also had a question on SaaS business, I guess, right? No. I think did I cover all your questions, Ashish?
Yeah, thank you, sir. We'll move to the next. The next question is from Mr. Harpreet Punch. Sir, request you to unmute yourself. Please introduce yourself and the firm you represent and go ahead and ask your question. Yeah, Mr. Punch, please go ahead.
I just want to understand, there are two targets we are taking, rather, what I understood. One is 760 crores and 15 crores EBITDA. And then second is basically 835 crores and then 30 crores EBITDA. So we would like to be, certain which one targets as an investor we should take, rather than as a management you are taking internally. But as an investor, what target we should take? Number one. Number two, what is our employee strength right now? And number three, any pipeline for the new business lines? That's what I want to ask.
Yeah. So the first target, I think what we should commit is that outlook we are given is as of today, we will quarter on quarter, we will review it and upgrade it, which is 760 crores and 15 crores is what we are saying right now. 100 crores order book is what we are trying to achieve. That's a target we are running with. Conversion of order book of 100 crores will translate. So to your question, I think we should take 760 crores, 15 as a blood commit from the management team today, as of today, right? Assuming even if we don't sell anything the whole year and my entire sales team goes proper, we will hit these numbers. It's as simple as that. Okay, that's the one. The second point is, you had a question on what is the that's one. Yeah, the employee headcount exactly. Yeah, so the exit is 5,600, Harpreet. So there also, if you look at it, we are more focused on trying to increase our employee mix also. It's a very, very clear strategy. We are closing out low value contracts, which are high on headcount, low on margins, low on value, on revenue per employees. So for us, the very, very important aspect this year is growing the revenue per employee. So our focus will be not growing the number of headcount, but replacing headcounts with more profitable revenue. So more of cloud first, more of AAA, more of digital IMS, more of automation-led BPS is our focus. And so we want to change that mix of revenues drastically and not allow any of these volume driving mixes away actually. Though it is very tempting for all of us because it gives you top line, it gives that, but we have taken a very, very clear view. We are not going to do that because that's not going to help us in the long run. So that's my point on the employee mix. The other question you asked about is the pipeline we are talking about. I'll quickly touch upon some pipeline. We spoke about, last time we spoke, the large deals in terms of the cloud transformation. Those deals are now starting to give us better revenue, better run rate revenue. So realization of those large deal revenues will be here this year. So that's a positive side. Similar pipeline is building because we want to kind of, see how we can leverage the best practice across the world. So the cloud first, cloud transformation, very similar to Bamboo Rose kind of deals are our focus areas. We are focusing. Second also is that we are also having plenty of pilots now in terms of automation-led digital BPaaS, if I call, in the mortgage industry. We are very hopeful some of these paid pilots will pay off because these are next generation deals because we are disrupting existing incumbents in terms of its cost per transaction because it has to be high on automation, high on cognitive index. These pilots are paid pilots. Hopefully, these are in our main geographies like US. We are hoping that these will materialize into large deals for us this year. And these could be really, if we win it, Harpreet, I will come back and change the outlook by end of Q1 for sure, because in fact, we're all busy traveling and trying to close these deals as well. Finally, also, one important pilot also we are running is blockchain-powered, background verification. It's a very, very important project for us, close to our hearts, because this again disrupts the way background verification is done today in the industry today. If we are successful in our pilots, this could be path-breaking for 3i Infotech. This could be massive change in the revenue mix itself. And these are pilots happening in UK. We are very hopeful these pilots and POCs converts into large deals. And I'm just hoping we close these deals in Q1 and I'll come back and tell you guys in Q1 end that we have closed these deals happily. And of course, beyond that, there are a lot of volume deals which are happening. In fact, in our infrastructure management space, there are plenty of deals we have won and we are adding that. The digital infrastructure management and even in our application development as well, which the funnel is pretty good, which is building quickly.
Thank you, sir. There are a few questions in the chat box. We'll just take a few of them before we go back to the raise of hands. One, Mr. Sudhakar, in terms of debt to FCCB, is there anything outstanding or everything is converted?
No. No, we have not converted any of those debts to any kind of long-term options.
Yeah, the FCCB has been completely repaid. There is no outstanding and nothing is converted. So it's like zero debt, zero liabilities to anybody.
That's what I indicated at the beginning in my.
Yeah,
absolutely.
Thank you, sir. The next question is, what is the expected net cash position on 31st March 2023? Does the company need to raise equity or debt this financial year to carry out the plans outlined here?
We may have to take some working capital limits to the extent that we may need for a growth engine, for the growth of our revenue, but not any long-term debt. We may not be needing any long-term debt, nor we may need any kind of capital equity infusion.
No, absolutely. I think our focus will be to work within what we have and work within our residual receivables from our,
and any working capital that may be needed for the expansion.
Absolutely.
Thank you, sir. We'll take a question from the raise of hands. Mr. Siddharth Gupta, we are going to unmute you. Please unmute yourself. Introduce yourself, the firm you represent, and ask your question.
Hello.
Mr. Gupta, you have been unmuted.
Yeah, am I audible?
Yes,
yes, you are.
Hi, good evening. I'm Siddharth Gupta. I'm partner at Voyager Capital. Congratulations on posting such a great set of numbers. It could have been better, but it's still pretty great. I'll just start off with a comment which is a suggestion from my end, and the others are a few questions. The first one is it sounds actually a little unethical to say this, but Ukraine has actually thrown up a great opportunity because it's the hub for outsourcing for Central and Eastern Europe. So given that we do have certain presence in Europe, yeah, we could probably explore, peddling our products there and capitalizing on this opportunity that's come up. That's the comment. My questions are, first of all, could you elaborate? So, I mean, it's great that we posted a standalone profit, but as a consolidated, we've posted a little loss. We've nearly broken even. So, could you just elaborate on what has been pulling us towards the negative territory? Secondly, are there any receivables left over from the carve out which are still to be properly received, or I mean, which if you could elaborate where and exactly they're on the balance sheet? This is more for the general public so that the information is more clearly dispensed. Thank you. Great that you clarified about the EBITDA with Harpreet's question. So if just correct me if I'm wrong, from what I understand, 15 crore is the minimum EBITDA that the company will achieve,
Yes,
assuming there's
absolutely.
no further sales that's happening. And
Yeah.
you're trying to be a 30 crore EBITDA company by the end of the FY, if that is the maximum range that we're looking at. So that's the ideal range we're looking at, and the revenue is from 760 crores to 835 crores. Uh,
Absolutely.
that being said, you did mention a 100 crore order book. So is the 760 crore incorporating the same, or is it exclusive of that 100 crore
Exclusive.
order book?
Exclusive. 100 crores is the sales target, Siddharth. Separate.
Okay,
So I
so
said,
assuming that 100
yeah.
So, assuming that 100 crore order book doesn't go through, I wish it does, but assuming it doesn't, we'll still hit the 760 crore revenue
Yeah,
target.
that's the point I'm making. We'll still hit the 730 crores. Yeah, absolutely.
Okay. Okay. And my last one is, I mean, you did mention that you're not looking to dilute any further equity, but there was an exchange filing yesterday about about an ESOP plan that was implemented. Could you just elaborate a bit more on what more sort of equity dilution are we looking at through the ESOP program? Because that has been a concern for shareholders for a while.
Okay, I think there are a few. We'll go one by one.
Yeah,
I think maybe you answer the first one.
Let me
on the profitability.
get the first two ones, Siddharth. The impact of our dormant territories that we are operating in is pretty low in terms of the overall consolidated results. I would say it is not even material to that impact because we don't have any running expenses in those territories. It's primarily we are waiting for certain intercompany related transactions to get closed, and probably that will itself take care of closure of those dormant territories. That is one. Secondly, on the essential receivables, the carve out receivables that you spoke about, we have about approximately 60 odd crores to get to be received from Essentio. Now this is on a couple of accounts. One is the deal related. Now deal related is more on the CPs that we have signed with them, which is getting closed one by one. I mean, we closed one CP on the BTA transfer of the Saudi related entity. We also have now the Thailand one, which is getting through. We had certain regulatory related I would not say certain documentation to get completed, which is getting closed in the next 1 month or so. So these are some of the I would say CPs that we have for the deal related receivables to get through. Other than that, we have some current account receivables on account of customers non-novated, because we are also in the verge of transferring all the customers to them. So whichever is a non-novated customer, for that we are supporting. So we have some invoicing which we still do. So that all put together, we have about 60 odd crores which we have to get, I think, and that is planned during this year.
Yeah.
You want to take the other ones?
Yeah. So the other ones are, and the first question, I think, Siddharth, you spoke about Ukraine. In fact, we were on the verge of setting up our center in Ukraine. It's unfortunate that this war has broken in, and because there's a fantastic talent, and even from a cost perspective, it's pretty aggressive. So we're also, as I'm speaking to you, we're also trying to evolve. A lot of Ukrainian refugees today are now in Poland and Slovakia, are willing to work, and these are very aggressive rates. And we're now trying to see if we can leverage that pool. One is, how do we leverage them? And in fact, it's remarkable. Some of the rates are more aggressive than what we pay in Bangalore or Hyderabad, and very very good quality resources are available. So we're trying to leverage that. So that's the like as I said, it's unethical, but we also want to kind of see how to leverage them. One is trying to provide livelihoods to the refugees, but also from a business perspective, we're also able to attract good talent from there. That's on that point. The other point which you spoke, I think I clarified on the 760 crores and on the profitability stuff. And because of the important aspect is for us to convert this 100 crores order book, into revenue, and how to want to kind of drive better margins for us. I think that's a very very key focus for us this year. Because of margin change, margin mix change is our focus for here. So we are not really going to go on the top line just because you want to hit the volumes. We want to look at the quality of revenues, change the margin mix, optimize our cost, eliminate waste systematically. I hope I answered all the questions, Siddharth.
Yes, sir. We'll go to the next question. Mr. Asid Koti, we are going to unmute you. Please unmute yourself and ask a question. Yes, Mr. Asid, please introduce yourself.
Hello.
Mr. Koti?
Yeah, can
Yes.
you hear me? Yeah. I had put in a couple of questions. One was about 5,000 employees or 5,600 employees. If you have to break it up into offshore and onshore, how is it? And in terms of marketing and others, how do we break it up? That was one, and there are a couple of other questions which I have already put it on the chat box.
Yeah. So see, the mix of employees predominantly we are all is India based. If you look at it, if I look at the other way around, US we have around total on-site will be around 600, and the balance is India based. And now the important mix, like the other question which was asked also was that what is the mix of India to India versus India to onshore export business, because that's what was very very important for us to make a change in that. And if you look at a sales and marketing perspective, if you look at it from a cost perspective, we are investing almost close to 37 crores. If you look at it, number of people, if you look at it, because if you look at sales, marketing, if your question is on SG&A as a whole, if you look at it, yeah, so all put together will be around 100 people, sales, marketing, and sales support, everything, all put together. Inside sales put together will be this across the world. Predominantly, most of them will be, of course, India based. Obviously, and we have people across the world in the geographies as well who are client facing, client partners, sales hunters, and that's the structure which we have on that. Yeah. And also, I think one question on Snyder, I think there's an ESOP's question by Siddharth. Maybe we can answer that. You want to maybe answer that because this is the latest filing on the new ESOPs.
So we see an addition to equity to the range of about 3 to 4 crores during the current year, the ensuing year. But we need to see also the charge to PNL we have not taken, but the equity should be in the range of about 3 to 4 crores.
The new scheme which we are launching. The new scheme which you are launching.
The existing as well. You might go on the vesting period.
Yeah. I think the filing was on that. Because I think the main point, Siddharth, also is for us, we have spoken about it. It's very important we have to do this balancing act on ability to attract talent. Because for us, the single biggest problem is, to attract talent. So unless we have some of these instruments, whether it's for ESOPs for grow and ESOPs for build, will be very difficult for us to attract the best-in-class talent. So we need to do that balancing act, as a, need the support of the shareholders also to try and see how we can, balance this, because this will have long-term gains for all of us.
Thank you, sir. We'll move to the next question by Mr. Iqbal. Please, Mr. Iqbal, please unmute yourself, introduce yourself, and ask your question.
Sir, I have already asked the question. My question is answered.
Thank you.
Thank you. Yeah, Mr. Purushottam, please go ahead, unmute yourself, and introduce yourself and ask your question. Mr. Purushottam?
Yeah, can you hear me?
Yes, we can hear you.
Yeah, good evening, everyone. Thanks for giving me this opportunity. And let me at the outset congratulate Thompson, you and your team for coming up with much improved numbers as compared to what we were seeing earlier. There is clearly a turnaround which is visible now. So that gives satisfaction. Now, I have a couple of questions. Just bear with me. One is we talked about last time that there is business mix in current portfolio, which is low margin. We want to get rid of that business, get it replaced by a new business, which is 20% plus kind of operating margin or EBITDA. So one is I wanted to understand how much is that low margin business left in terms of percentage, and what is the timeline we are looking at in terms of bringing it to the normalized level. That's number one. Second is not to criticize because I'm a shareholder, I always remain a well-wisher. Just wanted to highlight a point that, look, we talked about our cost structure being high because we have more of onshore mix as compared to the other service organizations which have a higher offshore mix, and that is why they have an advantage of coming up with better operating margins. But then if that is the case, then our revenue realization should be much better than others. Whereas what we see is that with 5,600 employees, our realization per person in case of 3i Infotech works out to say around $15,000-$16,000. Whereas if you compare it with the other organizations as your competitors, they are in excess of say around $40,000-$45,000 a year. So I mean, at one end, it's a double whammy kind of thing that at one end our revenue realization is say around 1/3 or maybe around that. At the same time, our costs are also higher. So maybe this is something which you may as an organization like to look at, normalize. So these are two things I wanted to ask and just a highlight of third question. We talked about 15 crore EBITDA for next year with say around 760 crore of revenue, which works out say around 2% of revenue. Now with 2% of revenue being EBITDA, if we have the other costs like depreciation, amortization and other expenses, that it will again put us into negative PAT territory. So are we saying that next year again we'll have a negative PAT? So these are the three questions I have. Thanks.
No, great questions, Purushottam. So I'll try and take it one by one. See, one is the revenue mix you spoke about. See, the revenue mixes today, all said and done, whether it's a low margin or what we call the run business is still paying our bills, whatever it is. So we'll have to safeguard them, drive efficiency, can we get better? And in parallel, we are trying to build the other lines of business, which I've been telling consistently. So this year, if you look at it, last year was a year of building some of these new lines of businesses, piloting it, doing all that. So today we are taking hardcore P&L numbers for some of those lines of business this year. So you will see more of cloud first, more of cognitive, more of new ray lines of businesses which are coming, which are more profitable this year, which will change the overall mix. So that is very, very important. Then the second thing you spoke about, it's a very valid point. You spoke about the cost structures vis-a-vis to the onshore versus offshore mix we spoke about. So just to again underline that, see, when the carve-out happened, the services business was subsidized, the way I look at it, because it's not the primary business. Let's be very clear about it. 3i Infotech was a product-led company. Let's be very clear about it. Product-led company. There are core products which were generating profits. We are paying up the old creditors with that. And we also had services business. We have to be really clear about it. Now, when that gets sold off, now a lot of these costs were subsidized, but because services are providing intercompany business services for products and stuff like that, when that gets carved out, suddenly you have a cost shock. And that's what happens in any kind of carve out. That's what we have taken over. Now, what we're doing is that your question is spot on, Pushman. So now we need to, if you see my slides, in the run exactly I'm talking about the point is saying, how do we right size or dimension this business, what we inherited to those costs? We've been doing it, we'll do it even further, and so that we maximize our margins there. So importantly, we have to do. Now, all the new businesses, we are either doing it digital-led, cloud-led, nearshore, offshore, so the mix are going to be changed. So if you see that in 1 year, this will keep coming down and this will start going up. So that's where we'll get the ideal we are expecting at least next year. The other question which you spoke about also is the 760 crores versus 13 crores EBITDA. Very clearly our endeavor, if I just again re-emphasize, when I go for the others also, this is the outlook we have today. Definitely we have an upside on the 100 crore order book we're talking about it, which will contribute to all the other amortization costs, and at the PAT level also, we will be profitable for sure. Because this is like a worst case minimum as of today, where we are today, once we are stabilizing is where we are giving an outlook to you all, and then there will be an upside on top of it, for sure. So that's on that point actually, if you ask me.
So just to add to the revenue mix, low margin projects or the cost arbitrage that you're mentioning about having offshore resources as compared to on-site resources, I think we need to understand the way of business we are in. So the contracts that we have for the on-site resources are for domestic employees. It's not that something they have outsourced the work completely. This is an in-premise development activity that we would have taken, because the world is moving away from an offshore development model to a nearshore onshore development model now. So they are more comfortable with people being available at their disposal or at their, we can call, working in their time zones rather than different time zones. So I think if you look at how the industry is moving, more and more nearshore onshore projects are getting executed, and I think that's where we are today, and that's why we will not be able to leverage the offshore cost margins, I would say.
Yeah, I think there are two aspects, just to add to what Harish said, because one is the cost structures to do that. I think the question was more on the cost structures, which we need to work on it.
Right.
And of course, the endeavor is to change the revenue mix. And the important point we want to do it is we want to be right shore is the right word.
That's right.
Doesn't want to be, and it will be digital first, automation led, and they have examples. So that's where we want to make our margins. So it doesn't matter from where you're delivering. You can even delivering from America or within UK, but your automation mix is 40%, your cognitive is another 30%, your human mix is only around 30%. So that is where we want to move. Because we have missed the bus very clearly on the offshore model, because all our peers are all been in services business for the last 2 decades. And so we will never be able to catch up to that overnight. So we have to do something differently. So that's what we have to, we are building and doing. Yeah, hope I don't know, Pushottam, I answered your question myself and Harish.
Thank you, sir. We have one last question. And how much more ESOPs, equity dilutions expected in FY23?
We'll take that.
Yeah, based on our existing ESOP scheme that we have about 29 lakh options still open, which is actually part is vested, part is to be vested, and part is already to be exercised. So it's a combination of options to be exercised and to be vested, which amounts to 29 lakh options. So it is about, I would say, to the equity account, I was saying, it will be around 3 crores or which will be moving to the equity account.
Noted, sir. With that, that would be the last question. With that, I hand it over to Thompson, sir, for his closing remarks. Thompson, sir, over to you.
Yeah, thanks, Naida, and thanks a lot to everybody. I think great questions, and thanks for the word of encouragement from all the shareholders who spoke as well, because it's very important for all of us also to be motivated. It's very encouraging for all the support you've given us. Continue to support us, because this could be scripted as one of the greatest turnaround stories, which all of us could probably reflect back in the years to come. Thank you all.
Thank you. Thank you, everybody.
Thank you, sir. And thank you, everyone, for participating at the 3i call. We look forward towards seeing you next quarter. Thank you and have a great evening.